Howdy, Jacob here. Today we're going to look at Berry Corporation. Alright, so Berry Petroleum Corporation is an oil, gas, and consumable company. I presume before even looking at it that earnings and cash flow are going to fluctuate due to the price of oil. And recently the price of oil has been extremely high, so I'm assuming their earnings recently are going to be super high. Yep, last year 250 million, free cash flow of 222, and that's 2.5p in free cash flow. But companies like this, their earnings are very volatile. So just saying that for being a little skeptic about such a high dividend yield right now. 13.7%. I mean, if they could hold that, then that would be pretty great to just get 13% in a dividend yield and then still possibly get price appreciation. But let's see how realistic we think that is. So first, $500 million market cap, almost $1 billion enterprise value, so they still got a bit of debt. 396 million. The good news is that it hasn't gone up too much in the last 5 years. Yeah, so they're really not increasing their debt, which is good. It's never great to go into debt just to pay your dividends, and it looks like their dividend is heavily based on how much they make for that year. But their free cash flow is way better than their earnings, because their earnings is 147 million, 44 mil, minus 263, upwards of 250. And in the last 4 years, it's been 240 mil, 191 mil, 122 mil. So interesting that their maintenance of property, plant, and equipment is so inconsistent. Minus 121 million and then just nothing. There could be a chance that they offset it by selling off divisions, but we'd have to look more into that if it were close enough to a buy price. But as of right now, let's start making some assumptions. So on a revenue growth basis, I might just do 0 and 10, because the price of oil has been so high recently that I just think over the next 7 years, I think over the next 2 to 3, it could definitely decline, but at some point in the next 7 years, be at the same level of revenue as they are right now. I guess they've made some acquisitions, so if I'm including acquisitions in my growth, maybe I'll do 2% growth here, so a little bit from inflation and then a little bit from acquisitions, and then their margins just really all over the place. So I might do like a 10% and then a 20%, buy back 1% of shares. Have they been consistent buying back shares? And 51 mil, 47 mil. It's a good amount in comparison to the market cap. So let's try -1. Maybe 13. When they make money, it's obviously looks like they have great return on invested capital, but then it's just so inconsistent, because again, it's so dependent on the price of oil. So this 97 cents, I just don't know how realistic that is. So I might just cut it into third. Even at a third, though, if you're thinking about it from a dividend yield perspective, you're looking at greater than a 4% yield. So that's pretty great. But Yeah, it's with these assumptions right now, we're looking like it could give you a yield of 15%, and which I guess kind of makes sense because they have a 14% dividend yield right now, and we're assuming appreciation on the price. So this will be one I do a deeper dive into. I think I have Best Buy and um, BG Staffing to do a deeper dive in as well. But yeah, definitely a company I'm gonna do a deeper dive in. I hope everyone else does too. Um, and yeah, I hope you have a great rest of your day. Thank you.